All right, so what we want to do today, I'm going to put it in slideshow. This was our third class, end of August. We've had 7 months in a row of strong stock performance, which is pretty unusual, actually. Usually the stock market is a little weak in the summers. The argument is everybody's on vacation. And because everybody's on vacation, the volume's thinner. And when the volume's thinner, transactions cause more volatility. And so, whatever the argument is, maybe because of lockdowns and COVID-19, no one's taking vacation this summer. But anyway, we've had 7 months. The worst month is generally considered to be October. That's mainly because the two big market crashes happened in October. We'll see. I don't think stock market's in a bubble, but I don't think it's cheap either, but we'll see. We could have a 10, 20% pullback in the market. All right, so we're going to finish up these questions, the why, what, how. Any comments, concerns, anything you saw as you're doing your Google search that you want to bring up now before we get into this, unless you think we're going to get into it during the class? So everybody, y'all understand how you're getting ready for exam one, right? This big, massive question here. So, all right, I'm not seeing any questions or any chats. So we were in the why question before. So the why is tied to why are you investing? And I always tie that back to the liability. Someone was asking me what the favorite part of my career was. So I had 3 different careers. I started off in corporate finance. I loved corporate finance because I could find projects that I knew were adding value. So at the end of the day, I could go home and know I added value. I had a lot of projects where, I'm adding hundreds of thousands and not millions of dollars in value, a lot more than what they were paying me. So I could say, hey, you got a good deal, UTSA. But my favorite job was balance sheet minimization. Is when I was working on pension plans and life insurance companies and property and casualty. I had a liability, and then I would then have to take that liability and find assets that matched it. And that was a favorite part of my job. I love that. Students are asking me, what should I do the rest of my life? I had a long, good hour conversation with a couple of students this past week. Students calling me about careers, and boy, I'll talk their ears off. Some of them are really stressed out. It's like, Professor, I don't know what to do the next 50 years of my life. And I was like, don't worry, you don't have to make that decision. Your goal right now in this fall semester is extremely important. If you're a junior or a senior, this is when you get your jobs. Most firms, they only focus on hiring in September and October, and they don't think about it the rest of the year because it's just too much work. So if you're not interviewing September and October, you're missing something. You're doing something really wrong. And so what I told them, I had a discussion with one of my students this morning. I told her it's all about volume. You should be applying to as many firms as you can. If I were you, I would be applying to 5 to 10 firms at least every week, if not every day. I might be doing 5 every day. And just apply. But students ask me, well, I don't know if I want to do investment banking or corporate finance or investments or financial planning. And I didn't know that either. And you're not going to know that until you start. So you're not going to find your favorite job because you don't know what that is. So it's volume. So my recommendation is apply to a lot of places. And then if you get 4 offers, take the offer that scares you the most. I mean, it's that simple. The scarier the job, the more complicated the job, the more valuable it's going to be to you because you're learning something difficult. That's what finance pays you for, is learning difficult things. So my whole career, the big part of my career where I really, really made my impact was on balance sheet immunization. But when I was where you are, I had no idea what that was. I had no clue. I just happened to walk into it, and boy, I loved it. My least favorite job was my very last one. When I was VP of equities, I didn't like that because I was managing portfolios, these massive portfolios, these billion-dollar portfolios, but I didn't have any liability. I was just managing money without a liability. I didn't like that part. But that's just me. That's what I discovered I liked. I liked the pension plan, the life insurance side, where I knew what the liability was. I had to find assets. So that's the why part. And so that's why I didn't like my last job, because I didn't have the why part. I only had the why, the what and the how, but I didn't know why people were investing. Were they investing for retirement? Were they trying to time the market? Were they day traders? What were they doing? So I think this is a really, really important part of investing. So I said last class, a lot of firms handle the why question through what's called a risk questionnaire. And I am not a fan of risk questionnaires. So let me tell you why I'm not. Let me just show you. See if I can find it first. Get into it first. And interrupt me with questions as we go, because I can't tell if you guys are with me or not. So here's my favorite risk questionnaire. It comes, well, it's by Ibbotson. So you'll see the word Ibbotson somewhere up here. But I just searched on risk tolerance and Ibbotson, and I found this website. Ibbotson's everywhere. He's very popular. People just buy his and someone bought his firm. It used to be Ibbotson Associates. Dr. Ibbotson, he retired. And then later on, they sold his firm out. And I forget to whom they sold it. I can't remember, but his firm was bought out by another firm. But here's a risk questionnaire. So let's look at them. The first three questions, remember I said that most important question under the why is horizon. All right, so the word horizon, the first three questions, look at these first three questions. They're horizon questions. How many years until you're going to need to start withdrawing your money? Question number two, when I start withdrawing my money, how long will we withdraw it? So this is kind of retirement. So I'm 25 years old. I'm going to retire at 65, so I won't need to take any money out until I'm 40. And then when I start taking money out, I hope I live another 20, 30 years. All right. The next question is, when making long-term investment, I plan the money to be invested for. So those are all horizon questions. They're kind of the same question over and over again. So I'm not real sure the distinction between the first one and the third one. I think it's a little bit redundant, but those are the three questions. So the first three questions are horizon questions. The next three questions, 4, 5, and 6, and in questions 8 and 9 are questions about risk. It's your stomach for volatility. How do you handle volatility? And these are my least favorite questions. So they talk about 2008 and the stock market fell 31%. How would you react to that? Would you get out? Would you sell some but keep some? Would you just sit and do nothing? Or would you actually buy more? All right. So that's the first question. Yeah, so Anthony, that's what you're saying. So Anthony, I'm going to tell you the problem with this questionnaire and see if this affects you. You might not have this issue. I prefer to invest with little or no up or downs, and I'm willing to accept lower returns to invest. So here they're talking about, do you like volatility or not like volatility? The sixth question, when the market goes down, I try to sell some. You see how redundant these questions are? That was my point with UTSA. These questions are very redundant. What happens on question 4 if they answer question 4 and it's completely inconsistent with question 6? Or they then go back and say, hey, your answers aren't consistent. They don't do that. They just keep the questions there. All right, so that's 4, 5, and 6. And then question 8, again, September, October, the market bonds lost 4%. It's the same question again, this time about bonds. And in question 9, the chart to the right shows you 3 different investments. So again, they're trying to get your sense of volatility. All right, I'll come back to those questions, why I dislike them so much. So you have 3 questions on horizon. You have 5 questions with how do you handle volatility? All right, is volatility something you can stomach or not? And then they have 2 last questions, questions 7 and 11. And these have to do with your knowledge of markets. Are you a seasoned investor that knows what he's doing or she's doing, or are you a novice? All right, so those are the 3 type of questions: horizon, how you react to volatility, and your knowledge of markets. And based on that, they're going to decide how to invest for you. The knowledge of markets, I'm not so sure that's an important question or not. I'm not sure if someone doesn't have much knowledge, if that means that they should have less in stocks. That doesn't really tell me much. We had a mutual fund we did at USAA that used a lot of options. And the lawyer said, well, if you're using a lot of options, that's a sophisticated strategy. So anyone who doesn't have a lot of knowledge of markets shouldn't be able to invest in that fund. And our argument was we were using options to reduce the volatility of the fund. It was an ideal fund for people who didn't know much about markets and were worried about risk. So we had this big argument with the lawyers on that. Let me talk to you about the 5 questions on volatility. Why don't I like those questions? So Anthony, you said market sells off, I'm going to buy more. Well, here's what happens with most people. Most people are not Anthony. At least this is the way it works. When people answer these questionnaires in November of 2008, they answer them very conservatively because they just lost a lot of money. So they answer them as a very, very conservative investor. When people answer these questions, like in 2019, after the market's been up for almost 10 years, they answer them very aggressively. So the markets have been up. They say, yeah, if the market crashes, I'm going to buy more. When markets have recently crashed, they say, when the market crashes, I'm getting out. So what do the risk questionnaires have people do? They have people buy high and sell low. People answer these questions real aggressively when markets have been up and are probably expensive. So these questionnaires put them more in the stocks. And when markets have crashed, when people should be buying stocks, they answer these questions real conservatively, and the financial planners put them less in the stocks. I think it's the worst possible combination. So it would be great. These questions do not test risk tolerance. What they test is, for most retail investors, all they're testing is what have markets done recently. If markets have been down recently, these questionnaires will get them to get out of stocks and buy more bonds. If markets have been strong and up recently, it will get them to sell bonds and buy more stocks, which is the exact opposite of what people should do. So in my opinion, risk questionnaires push people to do the exact opposite of what they should be doing. I had that debate with USAA, the financial planners at USAA. None of them respected me. It was always this big debate between investment and financial planners. I had one financial planner come to my office with his boss, and he started right away telling me how to do my job, which I don't like. And I could have been really mean with him and just said, hey, you do your job, I'll do my job. Instead, what I did is what I love to do, is I just started pushing jargon on him. And after about 5 minutes, he was like, okay, I don't know what I'm talking about anymore. Not that I was trying to disrespect him. I did it in a way so I didn't embarrass him in front of his boss. But after about 5 minutes, he was like, okay, I'm out of my league here. That's the way it should be. I was the investment professional. He was a financial planner. He knows tax law. He knows all these, college savings plans, all that kind of stuff. That was his expertise. I knew investing. So I made it very, very clear very quickly. I knew stuff he didn't know, but they didn't believe that. They're like, we know as much as you invest in people. So I had to kind of put him in his place without doing it in a mean way. But he learned very quickly that we're differently trained and know some stuff. But I've battled with these financial planners, and they told me our risk questionnaire is very good. It's been tested. And I know that's not true. Most of these risk questionnaires have zero science behind them. So I battled with them. I finally gave in because mainly their argument with me is they just didn't want to do anything about it. That was something they've already taken care of. They already checked the box. They've got a risk questionnaire. That was done. No reason to debate it. But I had gone through USA's risk questionnaire, and they answered all the questions in every possible combination. And the allocations they were giving me made no sense about a third of the time. I even told them, if they answer question 2 like this and question 3 like this, it changes their recommended stock allocation from 60% to 40%. Do you really think that's the right answer? And they were just like, hear no evil, see no evil, speak no evil. They just didn't want anything to do with it. Their answer was, don't worry, we've researched it, when I know they had not done that. So it's challenging. I had this debate, I may have told y'all this, I can't remember, but I had this debate with Barclays Bank. Barclays they said, we have a risk questionnaire. And I said, I don't like your risk questionnaire. And the guy, I don't know, Anthony, if you're telling me, I've already told you all this story, I can't remember, but his answer was, Ron, we have a risk questionnaire, but we cheat. If you go to the risk questionnaire, it says, if you answer this, go to page 6. If you answer this, go to page 8. But he says, if you go through all the combinations, you'll discover it looks like it's doing all this sophisticated risk tolerance kind of stuff. But ultimately, all it looks like at is horizon. It ignores everything but horizon. It just makes it look like it's looking at other things. And I said, okay, that's fine, because horizon's the only thing we're sure about. If you have a 30-year horizon, that's a lot different than if you have a 5-year horizon. Now, a few of y'all are taking my life insurance class. I can't remember who is. Boy, I can't keep my classes. Let's see if I can recognize someone from my life insurance class. Boy, I don't think any of y'all, I don't recognize any of y'all. Maybe not. Maybe no one is. Let's see, I'll look through a little bit. Anthony says, oh, that's right, a V. I see you're saying your name correctly, a V. I've seen you in both classes. But so a V, your paper 1 on human capital, especially that second article, they talk about why do young people buy more in stocks and older people buy more in bonds. It all has to do with human capital. Your human capital, which is the present value of your earnings, that looks like a bond for most people, not everybody, but most people, your future salary looks like a bond. So when you have a career, most of your assets is in bonds because that's what your income looks like. And because of that, you can put most of your investment portfolio into stocks. I actually think 20-year-olds should put 100% of the money in stocks, but that's not what the financial planners will tell you. They'll put 90%, 80% in stocks, but I think you should just do 100. But as you get older, your human capital shrinks, so you don't have that big bond. So it's essentially your human capital is maturing. And so because you have less in bonds related to your human capital, you have to put more in bonds in your investment portfolio. So that's the argument for why young people should have more in stocks and older people should have more in bonds. It makes perfect sense. And that's the reason why I think Horizon really does make the most sense. It really is a human capital type of analysis. So I'm not telling you throw out your risk questionnaires. I just don't think they make any sense. Now I have high respect for Dr. Ibbotson. I've met him a couple of times. He's a very smart person. And so he has this risk questionnaire. I don't know what science or math he's put behind it. I'd love to have that conversation with him. I wish I could go back to one of his conferences. I've only met him at his conferences. I'd love to ask him that question, but I missed that opportunity. All right, any comments up to there? Have I stepped on any toes? Did any of y'all try that risk questionnaire? You should try it and see what it says for you. I guess it's going to tell you put 80% in stocks. And it's probably going to tell you 80% in stocks and 20% in bonds. If you take my risk management class, you're going to discover why I have a strong problem with that. Stocks and bonds are not the only assets out there. There's other assets out there. There's real estate, there's commodities, there's infrastructure. There's a lot of other assets that are out there. Stocks and bonds are not great diversifiers, as we talked last class. Stocks and bonds are not good diversifiers if everybody's worried about inflation. They're both going to crash if inflation is a concern. So what are you going to have in your portfolio that's going to do well if inflation takes off? But most of these risk questionnaires, they assume stocks and bonds are the only thing available in the world. And so that's what they're going to move you into. So question our field. We do I think some really bad stuff in our profession. We do things that make us a lot of money, but then in a crisis end up losing our customers a lot of money, and we're okay with it because we're still making money. But I'm hoping you'll think differently about that. So that's the why question. All right. Now let's get to the big question, which is the what question. This is where we're going to be spending most of our time. So the what question is, what can you invest in? I just mentioned that for most people in the United States, the what question is stocks and bonds. So in this class, I want you to think beyond just stocks and bonds, that there's more to it. And most of y'all are not on video, so I'm never going to learn who you are. I will say, if you're not going to do video, at least put a decent picture of yourself out there so I can start learning who you are, because some of y'all don't look like your ASAP question and pictures at all. So, all right. So the what question, this is what we call asset allocation. It's also known as your beta risk. I don't know if you've ever heard that before. The word beta in finance has many meanings. And you know, beta has a term in geometry and in statistics. But the word beta, whenever you see the word beta in finance, we're talking about what asset classes you're in. Are you in stocks? Are you in bonds? Are you in real estate? What is your beta risk? All right. The difference between alpha and beta is what? Beta is what assets are you in? Alpha risk is whom are you hiring to try to make money in those assets? Are you going to hire Fidelity? Are you going to hire BlackRock? All right. So that's alpha versus beta. What did Google change the name of its firm to? Anybody remember that?
Alphabet.
Alphabet. What is alphabet? Alpha. It sounds like alphabet, like A, B, C, D, E, F. But most people think that's not what they're saying. They're saying alphabet. Alpha is how you beat the market. And when you try to beat the market, you're taking a bet. What is Google saying? Buy Google. You can beat the market with our stock. That's what most people think they're saying. Now, some people think it's alphabet, like they have this special hidden company that's doing A, B, C, D, E, F. They're doing everything. They're building autonomous vehicles. They're doing artificial intelligence. They're doing the cloud. They got this entity that's doing all this crazy stuff. That might be it as well, but that alphabet is in there as well. So there's an alpha trying to beat the market. There's beta that just says, what markets are you going to be in? So that's where we're going to spend our time. How many asset classes are there? I'm going to give you the conventional approach, which is what you really want to do. I will allude to some other ways of thinking about it. All right. So this is where I'm going to help you tremendously in your interviews. So if you have interviews and they ask you the question, what should I do if someone suddenly gave me $100,000? You're going to give the why, what, and how question. And then on the what question, you're going to go in deep detail. So the what question is, what can I invest in? Can you buy bonds? Can you buy stocks? All right. So here's a term. I don't know if you know this term. Parsimonious. Is anybody, I don't know if y'all use that very often. Your goal this week, and you'll let me know this week, your goal this week is to work the word parsimonious into a conversation, just kind of nonchalantly, and see how people react. See what your friends say. So your friends say, hey, let's go out to eat. You say, no, I'm trying to be a little more parsimonious this week. And just, what do you think they'll say? And say it like it's a normal word, all right? Don't go parsimonious. Just say, I am trying to be a little more parsimonious this week. All right, so it's a good way to test their vocabulary. So the word parsimonious just means stingy. So when it comes to asset classes, we want to be stingy. All right, well, what does that mean, to be stingy? All right, so here's the key. We want enough asset classes, but no more. If 10 is enough, we do not want 11. If 8's not enough, then we want more than 8. All right. Now, how do we know when we have enough? Okay, so I'm going to show you a famous article in finance. Y'all know who William Sharp is? What's William Sharp's nickname? Anybody know?
Isn't it like the father of modern finance?
Oh, very good. Who said that? Very good.
Ashley.
Ashley, very good. Ashley, yeah, father of modern finance. Yeah, he's our guru. I've seen him once. He was speaking at a conference, in San Antonio. My boss's boss was there. And he asked him a question. He asked William Sharp, a Nobel Prize winner in economics. He's credited for putting PCs in the finance back in the 70s, to put the computer in the finance. My boss's boss asked William Sharp, what are you working on now? And William Sharp said, well, I was doing a lot of finance, but the mathematics of finance is over my head now. So now I'm working on financial planning. And I was sitting there thinking, if the math of finance is over his head, I'm in a lot of trouble, because his math skills are a lot better than my math skills. So it's kind of a scary question. He's working on some really exciting things, something we're not going to do in this class. We are going to talk about it in my life insurance class. So V, remember that articles 3 and 4 for paper 1, that immediate annuity, that's what William Sharp's working on, is once you hit retirement, once you hit age 65, how do you take money out of your retirement to fund your retirement? That's what he's working on. Not only is he working on it, but he's built some really amazing models that are out there on the internet for free. So if you're working for a firm that's doing that type of financial planning, you might do a search on William Sharp and see what he has available for free out there. Now, it's pretty complex stuff. That's why I'm not so sure I really believe him when he says it's over his head. I think he was maybe being a little bit humorous. But here's the article. I know the text is a little small. I don't know why I use such small text, but I gave you a link to this article in the class notes. I found this article right after it came out in 1992. I was in this great job of, I had a boss that had not very strong math skills. He thought I was a math genius, which is pretty scary because my math skills aren't all that great either. I have good, calculus and matrix out, it's the basic kind of math. He thought I was a genius. I read this article and I started doing it immediately. I just started executing it at UTSA. I thought it was really cool. So this is an article, maybe over the winter break, you might read this. He's using quadratic formulas to solve this, but you don't need the quadratic formula. You can do all of this yourself in Excel. If you want to actually do what he's doing in this article, take my risk management class, because we actually do what he's doing in this article in my risk management class. So here's where he talks about parsimonious. Parsimony, there it is right there. So what he's doing is this article. He's talking about style analysis. But he starts off by saying, how do we figure out what asset classes we want in our model? All right, let's take one model. We only have 2 asset classes, stocks and bonds. Is that enough, do you think? Just 2? Well, what he says is, let me take a mutual fund. Let me take a portfolio. So maybe Fidelity has a mutual fund. Maybe it's their balance fund. I'll take their fund and I'll take 2 asset classes and I'll see how much of the volatility of that fund I can explain with just those 2 asset classes. If he comes back and he says, I can only explain about 60%, say, well, what's going on with the other 40%? Well, maybe I need more asset classes. Anybody know what that 60% is called? What did y'all learn that term is in your stats class? It's on this page.
It's R squared, but it's a proportion of variance, right, sir?
Right, the R squared, there's other terms for it, but R squared is correlation squared. So that 60% is the R squared. So that 60% tells you how much of A can be explained by, how much of the volatility of A can be explained by the volatility of B. So what we're trying to do and how many asset classes we need is we're trying to explain risk. We're trying to explain how much risk is this manager taking. And we'd like to be able to explain 95% of their risk. We know some of it's that alpha risk, right? They're trying to beat the market. So some of it's going to be that alpha risk. So that might be 5%, 10% of what they're doing. Maybe they're moving between growth stocks and value stocks, and that's going to create some noise we can't explain. But we'd like to be able to explain as much as we can. If we can explain 95% of the risk that most managers are taking with 3 asset classes, then 3 is enough. However, if we need 25 asset classes to explain 95%, then we probably need 25. Right? So that's what he's talking about. So there's that term parsimony. You want to be parsimonious, you want to be stingy. Why do you want to be stingy? So let's say, okay, we want stocks, we want bonds. Well, maybe we want large company stocks and small company stocks. We want to split those up. We're going to do that in this class. What if we want to split US stocks versus non-US stocks? We'll do that in this class. Maybe we want to break non-US stocks between developed countries and developing countries. Well, we'll do that in this class. Maybe we want to break stocks between growth stocks and value stocks. All right, we'll do that in this class. That all makes sense. Do we want to break out real estate investment trust stocks? Do you want to break out utility stocks? Does that make sense? Well, now we're going to have like 40 asset classes. How deep do we want to make Apple its own asset class? So Amazon, Apple, Google, Walmart, their own asset class. Do we want to do that? That seems a little extreme, does it? Do we want 80,000 asset classes? Every single security is its own asset class? That seems a little much. So what William Sharp's going to say, and he comes up with his list. Here's his list. I forget how many he has. Let's see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. He has 12. But he did this in 1992. I wish he would update this article because I'm pretty sure his list would look very, very different. Now we're going to use, there's about 70% overlap between what we're doing in this class and what he's showing here. All right. So there's definitely going to be some overlap. But these are the 12 he came up with. So if these 12 is the right answer, why not do 13? And the reason you don't do 13, if you can explain 95% with 12, and adding 13 just gets you to 95.1%, he's going to argue, don't add the 13th. Why? Because if you add the 13, it's a tremendous amount of work. You have to now go out and interview managers for that 13th asset class. At UTSA, every manager, every asset class we had to interview like 100 managers. So you add one more asset class, you're talking about an extra 2 meetings every week. I don't want to do that. That's a pain. In fact, we had managers wanting to come visit us, and I finally had a rule. They could not come to UTSA. They only could call. And that way I could put them on speakerphone. If we had a really bad manager and it's a waste of time, I could just put them on mute and I could do the rest of my job. Like probably some of y'all are doing and just ignoring me, and you're going to regret it later. Once you get ready for it, right? You're supposed to be writing your exam answer right now. But that's what I would do. What I tell y'all not to do is I had a manager just, boy, I can tell I would never invest with this manager, but I don't be rude. So I'm going to do other work and kind of halfway listen to them. Yeah, so that's what we did because it's a lot of work. If you decide that real estate investment trust is a separate asset class, you're now going to have to interview 100 real estate investment trust managers. And if that doesn't explain much more risk, you're better off just real estate investment trust as a small cap stock and not separate it out. Okay, y'all understand that parsimonious? Now, at UTSA, we had 13 asset classes. He has 12. Now, let's look at some of these and see if we're going to recognize some of these. Bills. I'm not going to call it bills. What do you think I'm going to call bills? Any guesses on that? It's not the Buffalo Bills. What do you think we're going to call bills?
No.
Fees? No, not fees.
Bills.
What asset class would that be? Did you read ahead in the notes? The major asset
Cash and
classes?
cash equivalents.
Cash and cash equivalents. Now, what are bills? Who issues bills? You see the word bills. What entity do you think of?
Government.
The government, U.S. U.S. government, right? U.S. government issues bills. All right, so we're not going to call it bills. We're going to call it cash and cash equivalents. We're going to include corporations that borrow short term. All right, but he calls it bills. Intermediate government bonds. We're going to talk about that term, intermediate term. That's going to be really important for us. We're going to use the term. Did y'all read ahead and see the word duration? Remember the word duration, extremely important term. All right, so yes, intermediate term governments, long-term governments. Then he has corporate bonds. In my notes, I call that credit. Y'all remember the word credit? So how much credit risk do you want to take? But he doesn't break out long-term and intermediate-term corporates. I will. We're going to make a distinction on the corporates, but he doesn't. He has mortgage-related securities. We're going to definitely talk about that. I talk about in the class notes convexity. Did y'all get that far into the class notes? Convexity? Anybody want to give me a definition of convexity yet? My guess is you're probably still letting it sink in. Convexity is a great term to go out and look at Wikipedia and get a good understanding of it. They would be amazed if you could talk about convexity in an interview. That's where mortgage-backed securities come in. Large cap value stocks. We're definitely going to do large cap. We're definitely going to break out value and growth. We will talk about mid cap and small cap, definitely. He has non-US bonds. We will talk about that. That is still not an asset class for most people. We'll talk about why that's the case. At USAA, we almost added non-US bonds as asset class, but we decided not to, and I'll tell you why we decided not to. Now he has European and Japanese stocks. We are definitely not going to do that. Now, why did he do that? Well, the reason he did that is at the time he did this article, 1992, the Japan stock market was half of the world stock market, excluding the United States. Japan was huge. Now, what happens to the Japan stock market since he wrote this article? It dropped like 80%. But at the time he wrote this article, Japan was a huge part of the world market. People were talking about Japan taking over the United States, but it didn't happen. Japan fell apart. So at this point, he probably would not do Europe and Japan. What he's missing is what? China, Brazil, those emerging countries, Vietnam, South Africa. So he has those lifted. Have y'all heard the term BRIC before? BRIC? Brazil, Russia, India, China, and the only one that's done well, they came up with the BRIC, and what happened? The BRI of BRIC fell apart. Brazil, Russia, and India. India is doing okay, but China is the only one of those four that's doing okay. Some people actually called it the BRICS. They added the S for South Africa, and so what happens when they did that? South Africa fell apart. South Africa is going through a terrible, terrible time right now, but those are those emerging countries. But now that China has an economy that's almost as large, if not large in the US economy, what will he do today? So wouldn't you love to see his article today and see how he's running the numbers? So interesting stuff. We did this at USAA, this exact same thing, and we came up with 13 asset classes. All right, so you can get different answers. So how did he do this? I want y'all to see what he was trying to do here. And I'll give you an example. Hopefully y'all can see this. Let me see if I can expand it a little bit. Hopefully y'all can see that, right? I can see it, so y'all can see it. So what he did is he took this portfolio manager. He had this person managing a portfolio. It's called the Trustees Commingled Fund. And he ran his model with those 12 asset classes. And the first time he ran it, he got an R-square of 95%. So using these 12 asset classes, he could explain 95% of the volatility of this manager. And these are the allocations that he got. Now there's two really serious problems with this first column. The first problem is he's allocating negative 42% to mid-sized stocks. Not everybody can short markets. Now it's not too hard to do today, especially with some of these negative 2x funds. So I'll actually show you that it's really not as hard to short markets today as it used to be, but a lot of managers cannot short markets. The other problem is the portfolio only adds up to 73%. Where's the other 27% of the portfolio? So then he constrained it. Can anybody tell me what the constraint was in the second column? What constraint did he add? You still see negative numbers, right? So he didn't fix that. What did he fix in the second column?
It says that the coefficients are required to sum to 100%.
100%, exactly. Very good. So he put a constraint in and says, hey, we have to add to 100% because obviously this manager is not taking 27% and going and having a party. So, you know, it's got to add to 100%. How did that affect his R-squared? Not much. All right, so what did he do in the last column? It's kind of obvious there. In the last column, what he said, has to add to 100. and no negative numbers. There, his R squared dropped to 92, was still pretty strong. So he can explain 92% of what this manager is doing. So what is this manager doing? Well, 70% is value stocks and 30% is small cap. And I would bet if William Sharp had broken out small cap between growth and value, small cap growth and small cap value, he probably would have gotten 70% to large cap value and 30% to small cap value. That would be my guess. So who is this manager, this trustee commingled fund? This is a value manager. And what could we say about this manager? They're having a horrible time because we're looking at them from 1985 to 1989. What stocks were doing well then? Growth stocks. And this is a value manager. They're probably losing customers left and right because they weren't buying all those .com stocks. How did they do in 90 through 94? They probably had their best years ever. Just really, really great years. So, well, I think I'm off a decade, aren't I? Yeah, I'm off a decade. Sorry, man, I'm losing track of time. So I don't know how they did 85, 80. Yeah, I'm off an entire decade. They might have done all right, 85, 89. But if it had been 95 through 99, they would have done horribly, and then they would have done great the next few years. So this is definitely a value manager. All right. So if you take my risk management class, we do a style analysis on mutual funds. If you don't want to do that class, but you want to learn how to do style analysis, then email me and I'll send you the videos and you can do it yourself. It's pretty easy to do. It's not that hard. It's pretty simple stuff. So I started doing this with all of our managers. If our manager told us they were a growth manager and I ran the style analysis and they were actually a value manager, I'd say, okay, you're lying to us. You're not a growth manager. You're saying you're a growth manager, but you're really a value manager. And we're hiring you as a growth manager, so we're gonna have to fire you because we need a growth manager. So it's interesting. So William Sharp started this. You can do all of this in Excel. It's really simple to do. So it's powerful stuff. So I used to love doing this at UTSA. This is your career. You read an article and it's really interesting and you just start doing it. That's the beauty of finance. This isn't accounting. Accounting says, what does GAAP say? And you got to do whatever GAAP says. Finance says, I'm going to do whatever I want to. They add value. I'm going to read articles. I'm going to read books. I'm going to watch YouTube videos. I can listen to podcasts. And when someone tells me this works, I'm going to go out and try it myself. I'm going to do my own numbers, my own analysis. And if it looks like it works, I'm going to start doing it. I did this in my career many, many times, moving billions of dollars around, hoping I wasn't messing up, losing sleep, but pretty cool stuff, really exciting stuff. All right, so you don't need to read this article for the class, but I would strongly recommend you read this article over the holiday, the winter break, because it's a very famous article and very valuable article, very useful. So I gotten you excited about your career now. This is your career. You get to do stuff completely out of the blue just because someone wrote an article. It's really, really cool stuff. What I love best about my job. All right. So we want to be parsimonious. We want to do, it's called style analysis. Write this in your own words, so don't copy and paste. If you want to be an overachiever, then read William Sharp's article and quote him in your exam answer. That would be really impressed with that. So really cool stuff. You can certainly go into YouTube and type in William Sharp. He has some really, really, really good YouTube interviews. Most of them he's focusing on, I think there's one where Dr. Lowe from MIT is interviewing William Sharp. There's a really good series of YouTubes called In Search of the Perfect Portfolio. I can't remember exactly. I don't think it's Perfect Portfolio, but something like that. In Search of the Perfect Portfolio. And Dr. Lowe, who is one of my other favorite people in finance, Dr. Lowe from MIT is interviewing William Sharp from Stanford, a Nobel Prize winner. Very good interview, very interesting. I really recommend, maybe you can't do it during the semester because you're so stressed, but during the winter break, after you finish this class, remember you want to get this stuff into your permanent memory. Go watch some of those YouTube videos on In Search of the Perfect Portfolio. Boy, I wish I could remember the word that they use, but just some of the stuff we're talking about in this class, you're going to see it over and over again, but you can hear it from different perspectives, and I think you'll find it really fascinating. So if you pick 5 asset classes and you run it against a bunch of portfolios and you're getting R-squared, it's only about 70%. So for most of the managers you're looking at, you're only explaining about 70% of the risk. Then you have to ask, what's the other 30%? So then you try with 10 asset classes, and now you get an R-squared of 98%. So wow, you're doing a great job. And then you add 5 more asset classes and your R-squared only goes to 98.1. What do? 10 is probably the right answer, because adding those other asset classes over 10 is just an enormous amount of work, and it's not going to help you explain much more risk. It's just overkill. Obviously, if you have every single asset in the world, so you have, 100 and something thousand assets, you'll get an R-squared. Even then, you won't get an R-squared of 100% because they'll be buying and selling them throughout the period. So the style analysis is looking at you if you just hold those assets the entire time over the period you're looking at. So if they're going in and out of assets, you're going to get some noise. Some noise is always going to be present. It's impossible to get an R-squared of 100% unless someone just buys that asset class and holds it. If I did this with the S&P 500, or let's say I took a Vanguard index fund, I've done some style analysis on them, and you will get an R-squared of like 99.9998%. Because they're buying that asset class and they're not making any changes. So I've never gotten exactly 100%, but I've done 0.99 something percent. So you can get pretty high, but that makes sense because they're just doing one thing and they're never changing. In my risk management class, some students have managers, they can only get a 75%. And they have to use my asset classes because I only, that's all they have to work with. In that particular class, I only use like 9 asset classes, so I'm missing a few. And they're using some managers that change their strategy a lot. So it is possible with managers, if they're making a lot of changes, you may not be able to get an R-squared much above 70. I haven't seen too many managers where you couldn't get at least 70%. If they're just doing something really crazy, that would be really unusual. All right, so here's a good point for questions, because there's at least one of you in this class that's like, boy, what is he talking about? And it might be over half of you. Is this sinking in? You get an interview today and you want to tell them about parsimonious and how many asset classes. Could you, off the top of your head in English, organize, explain what I just did here? And that's the key for whether you know it or not. Go find your 10-year-old nephew and explain this to him. And if he understands it, then you understand it. How many of y'all have a 10-year-old nephew you could explain this to, all right? Call him on the phone and say, I don't know what they're naming 10-year-old nephews these days, but so Bob, I want to explain to you style analysis and parsimonious selection of asset classes. And at the end of it, can they understand? Are you to that level of understanding of this, that you could explain it off the top of your head, not reading from notes, off the top of your head with no notes, you could explain this concept to a 10-year-old. It can be a 10-year-old niece. She might figure it out better than your 10-year-old nephew. So, it can go either direction, find someone. All right, are you off to that level yet, or you just need to think about this some more? You might go to YouTube. I haven't tried this. You might go to YouTube and try putting style analysis in YouTube and see what happens. That would be pretty cool. There's some really great YouTube channels out there that do this kind of stuff. I'm going to try it while I'm talking to you. This is pretty cool. Style analysis. Oh my word. It has nothing to do with finance, the first few. The first one is the Princess Diaries outfit analysis. So I don't think that's what William Sharp was writing about. So, but the 5th one down is style analysis, performance attribution, and Zach's research system. Why is this so important? Well, many of you, your first job, you are going to use FactSet, you're going to use Zach's, you're going to use Lipper. What did those software packages do? They do style analysis. just think about if you're interviewing for a job that they use FactSet, and the person you're interviewing with uses FactSet but has no clue what style analysis is and how it works, and you can actually explain it in words, they're going to be really impressed. And I know people in finance that use FactSet, take all the style analysis numbers and have no clue what FactSet just did. That's why I love in my risk management class, we actually do it by hand. We do it manually, well, in Excel. And then you get your first job and you do it in FactSet or you do it in Lipper, you're going to understand it better than that graduate student from Stanford is going to understand. So that's pretty cool, right? I'm trying to give you the edge here. So go, I don't know how good that Zach presentation is. It's 30 minutes. Maybe you type style analysis and the word sharp with an E on the end of it, and then see what comes up. The genius of sharp style analysis. Boy, I'm almost want to cancel class and go watch that right now. Boy, that looks, I look there. That's the one y'all need to go. I don't know if y'all are seeing that or y'all seeing that same one on YouTube. I typed style analysis and then SHARPE. And the first thing that came up was a site called Modern Financial Analysis. And it says the genius of the sharp style analysis. When should you go watch that YouTube? I would recommend you do it right after this class. What better way for your brain to let this stuff sink in than to see someone else's perspective? And I don't know who does this video. It might be the worst thing imaginable. I doubt it, though it looks pretty good. Style analysis, how does it work? The Princess Diaries outfit analysis, I don't recommend that one. So there's still a lot of these that have nothing to do with finance. In fact, most of them have nothing to do with finance. So we came up with style analysis before Hollywood did. So I would go with his. All right. Any questions on that? I'm not seeing anything in chat.
I had a question that kind of pertains to whenever we were talking about, this is Hunter, by the way, about the beta. You said that the beta will be in different markets, but then if you're trying to diversify your portfolio, and say you're probably going to have different betas for each market that you might be in, how would you try and at least get the average beta, or would you have to just make sure you pay attention to each beta for each market that you're in?
Okay, so that's a good point. There's beta, which is a mathematical calculation we'll do later in this class. That's the beta that's in the capital asset pricing model that you saw in 3013. We'll see it again in this class and you'll use it. That's a mathematical concept. The beta I mean here is a theoretical one. It's related to that beta and came out of it, but it's not that beta. So when you hear the word beta in finance in the theoretical construct, it just means which asset class you're exposed to. There's the other beta, which is usually against US large caps, which is how much systematic risk do you have? All right. So there are two different concepts, but they're highly related to each other. So was that Hunter? I'm sorry, that you asked that?
Yes, that was
Okay.
me, Hunter.
So Hunter, something that you can do, and all of y'all can do, is really, really, really cool. I don't want to mess you all up for all your other classes, and you fail all your other classes because you're searching all this really cool stuff. But if you go into Google and type alpha, you know how to spell alpha, A-L-P-H-A, alpha, beta, separation, alpha, beta, separation. This is too advanced for this class. I'm just telling you, man, if you want the $700,000 job a year, $700,000 a year job, then, expose yourself to this stuff. And go to Wikipedia, maybe go to Investopedia first, but go to Wikipedia second. And Hunter, you'll see what I'm talking about, the concept of beta. Beta is used, the first beta was in the capital asset pricing model, but it's taken a life of its own. I love alpha beta separation. It's a great term. I used to use it at UTSA. It's the use of hedge funds to get your alpha and using index funds to get your beta. That's where beta is used in the concept of the more theoretical approach of your exposure to asset classes. All right, so I see Wikipedia has alpha beta transformation. I don't know why they don't have separation. I'm not seeing that. I don't think that's not it. That's some kind of matrix algebra or something. So alpha beta separation is a really cool concept. It might be a little advanced for this class, but I do think if you read about it, I think you would see the link for what we're talking about in this class. All right, so what drives parsimony? Well, for asset classes, we're going to see there's three things an asset class brings. It brings an expected return, it brings risk or volatility, and to your point, Hunter, it brings correlation. How highly correlated it is. So what we're trying to do is find enough asset classes so we get all these different types of expected returns, expected volatilities, and expected correlation. Right? Now, correlation is by far the most important one, which I think is to your point, Hunter. It's, why do we buy gold? Gold has a very low expected return and an extremely high volatility. Why in the world would you buy something that has a low return and high risk? Well, because it has very low correlation, even negative correlation to everything else. Gold is doing well when everything else is blowing up. So commodities is usually a separate asset. Now you notice William Sharpe did not have commodities in his list. You notice William Sharpe did not have commercial real estate in his list. Why is that? Well, because he didn't have any data. Back in 1992, he did not have data to be able to run that kind of information, especially on real estate. That's why I wish he would rerun his model today. When I was doing this at USA, we had commodities, we had commercial real estate. I mean, USA has a huge commercial real estate portfolio, so we had to have that asset class in our assets. Okay, so real estate, commodities, what do they bring to the table? They bring diversification, that correlation concept. Emerging market stocks, they're very, very volatile, so they bring a unique volatility, but they also tend to be well diversifiers, especially diversifiers to US bonds. US bonds and emerging market stocks tend to be uncorrelated. And so they tend to diversify each other. All right. Now, what do you put in your exam answer? You've got to decide. There's no rules on that. My suggestion is you put everything in, but you've got to decide what you put in and not put in. All right, come back to the what question, because we're going to go through all those asset classes, all right, in detail. So we're going to come back to what. We're going to go to the third question. What we're going to do is we're going to hit the third question here, which is the how. Then we're going to go back for several classes and do all the different asset classes. And then we're going to come back to the how question and get in specifics, things like mutual funds and exchange traded funds and all of that. So we'll come back to so we're kind of going a little out of order. The what question at high level, the how question at a high level, the what question in detail, and then the how question in detail. Exam 1 stops. You're going to do the how question at high level, and then the what question in detail. So exam 1 does not have the how question in detail. You don't have to go into that detail level, okay? So exam 1 is define a portfolio, do the why, what, and how questions at a high level, and then go into detail on the what question. That's the entire exam 1, okay, which is really the meaty part of this class. All right, so the why question, why are you investing? The what question, what could you invest in? And we want to be parsimonious there. Now we've decided all of that. Now we just got to execute. That's the how. How are we going to do it? And there's a few questions here. First is, what is your strategic allocation? I would put this in your notes if I were you. Another phrase for strategic allocation is the policy portfolio. POLICY, the policy portfolio. So the strategic allocation or the policy, the reason we call it the policy portfolio is you have an investment policy, and that policy says, here's what we normally do. We normally have 60% in stocks and 40% in bonds. That's our policy. All right. So what is that normal allocation you would do? The second thing you got to ask is, are we going to do it ourselves? Or are we going to hire a manager? And that answer can vary depending on what asset class you're looking at. So you might do it yourself for the bonds, but you might hire an manager to do your international stocks. Or you might hire someone to do everything. Some of you, I bet Anthony, you probably own some individual stocks. And if you own individual stocks, you're doing it yourself. But then you might own an exchange traded fund that's buying a bunch of healthcare stocks or something. You might not do that. But so if you buy Google and Apple yourself, you're doing it yourself. But then if you buy a mutual fund that's only buying healthcare stocks, then you're hiring someone else to manage that. All right. So you can have a combination of those two. At USA, we're all over the board. We could do almost everything except for we couldn't really do international securities. There was actually one point where the bond portfolio managers came to me and they say, Ron, we're buying these European bonds for our UK operations, and we really don't want to do that because we're not awake when those markets are open. And so they asked if there's any way I could take that off of their plate. So I went out and I found a manager in London to manage our bonds in London. And so they were doing it themselves for stocks and bonds, for real estate, for derivatives. But then when it came with non-US bonds, we went and hired a manager overseas. And that was my job to go find them someone to manage those bonds overseas. They didn't want to deal with that, right? And had to deal with currencies, and we'll get into that. So it can be any combination. Some people argue that large companies in the United States, there's no way I'm going to beat the market on that. There's all these MIT PhDs following that market. They got every model out there. They're so sophisticated. They know when the CEO they probably know when the CEO has COVID before the CEO knows. How am I going to compete with that? But these micro companies, these startup companies, there's not as many people following them. I think I can beat that market. So I'm gonna hire a manager to do my large company stocks, but then for a small company, I'm gonna do that myself. Some people might argue that. So there's all different types of combinations. Most retail investors, what should they do? If they have no background in investing, they should probably go to Vanguard and put all of their money in one Vanguard target fund and just hire someone to do the entire thing all in one fund. Why? Well, I don't know if y'all have seen the commercials. I hate these commercials. I saw one, this guy said, well, the commercial said, you can trade like the Wall Street professionals do, even if you only have a 5th grade education. I found that really insulting. I've not heard the commercial yet that says you can do your own child's appendix surgery, like the Mayo Clinic doctors do, even if you only have a 5th. Have y'all seen that commercial? You can operate on your own children, even if you only have a 5th grade. I haven't seen that, but in finance, for the same reason they say 5th graders with no education can do what we're doing. I don't believe that. That's why when that guy came in my office and he started talking down to me, that's when I turned the jargon on. I've done that. Some people, one lady said that makes you a bully. And I don't think I was a bully. I don't think I was that mean to him. I actually kind of saved him from embarrassment in front of his boss. But I do that. Someone comes in and says, I know about as much about investing as you do. I start using a lot of terms that I know they don't know. And after a few minutes, it's funny, that guy that was in that meeting, he became like my cheerleader. After that, every time I saw him in the hall, he's like, oh, Ron, you're so great. You're so wonderful. I was like, yeah, that's a little overkill. But I kind of won him over that we in finance actually know stuff. That's why I ask you as students, what can you remember from last semester that you learned? And if you can't remember anything, then what are you gonna do when that guy walks into your office and he thinks he knows as much as you do? How do you turn on the jargon if you don't know any, So the third thing you ask is, well, am I going to be tactical? Am I going to try to beat the market? So if I think growth stocks are overvalued and value stocks are cheap, which is kind of my play right now. I've been doing this the last few weeks. It's been working pretty well, but we'll see. We'll talk about later how that's also a little bit of an interest rate play. Growth stocks do better when interest rates are low. Value stocks do better when interest rates are higher. So it's a little bit of an interest rate play. But if I do that, I'm trying to beat the market. I think I know something the market doesn't know. Now, that's a pretty arrogant thing to say, right? I'm saying all those PhDs from MIT, they don't know what they're doing. I know something better than they do. So I'm going to try to beat the market. I think Google is a place to be. I think Facebook's going to do great. I think Zoom, their stock price, how much did their stock sell off today? I didn't even look. So Zoom today is off 7%. I'm going to say, well, the market got that wrong. So I'm going to put a bunch of money in Zoom. Now, did the market get it wrong? Or did the market get it right? For you to say the market got it wrong is a very arrogant thing to say. Even if you're a finance major, it's a very arrogant thing to say, because you're competing against people that are spending 60 hours a week doing nothing but this. How many people do you know that have PhDs? Some people with 2 PhDs from MIT that are doing this 60 hours a week. And you're saying, I think I know better than they do. Well, maybe. We'll see. But that would be active. You think you can beat the market. You have some insight, some smart that can go on. Now, James Simons, y'all familiar with him? Have y'all Googled James Simons recently? That's a good name to Google. Probably the best investor in the history of the world. Not a finance person. What is he? He's a math professor, right? He's a quant person. He's a billionaire, hedge fund. How does he do it? We don't know. Why don't we know? Because if you have a secret, what do you do if you have a secret for beating the market? What do you do with that secret?
Hold on to it.
Yeah, you sure don't tell anybody about it. And what did he do? People said, hey, will you take our money, invest it? And he said, no, I'll just invest my money. I'm perfectly happy with that. So James Simons, you should read up on him. That's one of those names you should know who that is. It's kind of like knowing who Bezos is and Bill Gates and all these, Warren Buffett. So yeah, there's a lot of stuff you can really dive into. So active management, that's when you're competing against these people that are doing some pretty sophisticated, scary stuff. So that's what you're looking at. What is my strategic allocation? So strategic is, hey, if I don't have time to mess with this, I'm just going to invest and just let it ride forever and ever and ever. What is that? Am I going to do it myself or hire a manager? And am I going to try to beat the market? Now, you can beat the market in a couple of ways. One, and I've already talked about them, you can beat the market through security selection. So which securities do you want to buy, Google or do you want to buy Walmart? And you can be active with asset classes. You want to buy growth stocks or value stocks. So you can be active and passive. You might be passive on your asset classes. So I want 20% in large company growth stocks. But in that 20%, I'm going to pick those growth stocks I want, right? Or you can be passive on security selection. You're going to say, you know what? I think growth stocks are terrible right now. We're normally 20% growth stocks. I'm going to cut it down to 10, and I increase my value stocks up to 30. But I'm not going to pick the stocks. I'm just going to hire an index value manager and just go to the Vanguard, index the whole thing and not worry about it. I think my expertise is in picking the asset class. So some people think they have expertise on picking the company, the security. That's the most common. Some people think they're best at picking the industry. And some people think they're best at picking the asset class. And then you have the people that have no background in finance and think they can do all three of those. And if you ask them how they do, they're going to talk about that, all the money they made on their last trade. And why did they tell you that? Well, research has shown the majority of retail investors have lost money. And not only have they lost money, they've lost money in the best bull market in history. It's pretty amazing. How do people lose money? I don't mean they underperformed the market. I mean, they had actual negative returns in a tremendous decade-long bull market. That's how bad retail investors are. But if you talk to them, they will tell you how great they did. And why is that? Because there's one trade that they made that worked out. They're going to tell you they got Apple in their portfolio. They're not going to tell you that they bought it 2 weeks ago. They're going to pretend like they bought it 5 years ago. And they're not lying to you. They're lying to themselves. They actually think they're good investors. So that's what you're competing against. You're competing with people who think they know more than you do, even though they're horrible at what they're doing. All right. So that's what the how is. You got to decide these questions: strategic, tactical, do it yourself, hire a manager. All right. So execution involves what you actually buy. We're going to talk about that a lot. And that's with this alpha risk. We've already talked about this alpha risk. Alpha is your return versus the market return. So So if the S&P 500 is up 10% and you're up 12%, then your alpha is 2%. Okay. One other thing we do in my risk management class is manager attribution, where we actually grade a manager and see if they actually beat the market. And how did they do it? They did do it by taking more risk. So I think it's a really good class because it teaches you to do a lot of stuff that FactSet does, but you do it yourself in Excel so you can really understand it from the inside out. All right, so that's the how question. So we already talked about that, strategic or tactical. Now on exam one, the second question on exam one is a tactical question. You don't need to worry about it now. We're going to get a lot of practice with it before the exam, but it's a tactical question. Your boss thinks interest rates are going up. What should you do? Your boss thinks inflation is going to be a problem. What do you do? Your boss thinks there's going to be a recession. What do you do? So I'm going to give you a tactical question on exam one. I actually think it's more important than question one, but if you understand question one, you should do well in question two. All right. Are y'all writing out your exam one question answer as we go? We've got the 3 questions now. So the beginning of next class, I'm going to ask some of y'all off the top of your head without notes to walk me through the definition of portfolio and the 3 questions. Okay, so we're going to be redundancy. So you get really good at this. Where we're going to go next are the asset classes. All right, so read ahead on your notes. Get through duration or convexity in the notes or whatever I told you. We're getting into some of the stuff that I love. Boy, I'm going to be bouncing off the walls. I'm going to try not to talk fast during these sections because I get so excited. I'm drinking all this caffeine, which is not good, but this is some of my favorite topics. If I look out and you look bored or distracted, I'm gonna be in tears. I just can't understand how a finance major won't find this stuff really, really exciting because it is some of the coolest stuff in finance. All right, that's it for me. I'll stick around if you have any questions, but that's it. I'm going to turn off the recording button here.